Hey everyone, welcome back to Corporate Decoder, the place where we crack open the latest corporate filings to uncover hidden value and serious risks. Today we're diving deep into Banzai International's most recent SEC, filing a document packed with enough financial juice and legal drama to make your head spin. You won't want to miss the story of how they're trying to grow and the real reason they're scrambling for cash. You'll want to stick around for this, and hey, if you love getting these kinds of straight up insights from financial documents, make sure you're subscribed and join our Discord community linked in the description below for even more exclusive content. So what's the big deal with this filing? It's a registration statement that allows them to sell more of their stock, and boy are they trying to sell a lot, up to 25 million shares of Class A common stock. This is essentially them saying, hey public, we need more money, and here's a way for some existing folks to sell their shares too. Think of it as getting the green light to open the floodgates for more shares to hit the market. They've already done this before actually filing a couple of registration statements for similar stock sales. So this isn't totally new, but they're coming back for more. The date is September 12, 2025, and they're letting us know this is just the beginning. They're registered and ready to go. They're upfront though, saying this initial information isn't final and could change. And importantly for us investors, they're telling us this isn't an offer to sell securities, just a heads up on what might happen. Alright, let's get to the heart of it. Banzai calls itself a marketing technology or MarTech company. Essentially, they build software tools to help other businesses market and sell better. Sounds good, right? They claim to have helped over 14,000 global customers, from small startups to Fortune 500 giants. Their strategy is straightforward: grow by getting new customers, improve their product offerings, and sell more to existing clients. They've even made a couple of acquisitions recently, buying OpenReel and Vidello to add more tools to their belt. Their vision is pretty grand, building a suite of tools that become essential for their customers, and leveraging AI to make it all even better. They sell most products on a subscription basis, like many software companies do. As of June 30, their customer base was over 4,500 strong, spanning the globe. The really important part here is that no single customer makes up more than 10% of their revenue. That's good diversification. Now let's talk about what's been happening recently. Big news on July 2nd, Dean Ditto stepped in as their new Chief Financial Officer, replacing the interim one. This is often a sign of a company trying to get its financial house in order. And then on July 8th, they pulled a classic move. A 1-for-10 reverse stock split. This usually happens when a company's stock price has fallen too low and they want to artificially boost it to stay listed on exchanges like NASDAQ. They adjusted their outstanding shares from over 22 million to about 2.2 million for Class A stock. That's a massive change. And then the financial maneuvers continue. On June 27, they entered into a deal to sell senior secured convertible notes, raising $11 million. These notes can be converted into shares of their Class A common stock. This is a common way for companies to raise money, but it can also lead to a lot of new shares hitting the market, later diluting existing shareholders. They also issued warrants, meaning people who buy these notes can later buy stock at a set price. This is essentially a sweetener for the loan. They even had an additional closing in August for more of these notes and warrants. All this fundraising comes with fees. Rodman and Renshaw LLC managed this offering, and they're getting a substantial fee, 7% of the proceeds, plus a management fee. They're also getting warrants to buy more stock. It's a win-win for the advisor, but a cost for the company and its existing owners. Then on August 27, they announced an at-the-market or ATM offering. This is a way to sell shares gradually into the open market over time. It's less disruptive than a big one-off sale, but it still means more shares are coming. They've already raised about $377,000 this way, issuing nearly 12,000 shares. Back in December 2023, they signed a standby equity purchase agreement, or CPA, with Yorkville. This is a big one. Yorkville committed to buying up to $100 million worth of stock at Banzai's request. This is a lifeline for companies that need cash and can't easily raise it. Otherwise, they already got 4525 Millie got 4555 million requests that can change. Crucially, the prior registration statements for these shares are fully used up, meaning this new filing is essential to keep this funding option open. This CPR is a huge deal for stockholders. The market price could get hammered if Yorkville starts selling shares. The number of shares issued and the price they're sold at can fluctuate, making it hard to predict future dilution. It also means existing shareholders' ownership stake gets smaller. Now let's talk risks, and there are plenty. They admit they've had significant operating losses and might never be profitable. That's a big red flag. They even say there's substantial doubt about their ability to continue as a going concern. Basically, they're saying they might not be able to stay in business without more money. This is the kind of stuff that makes investors nervous and can cause their stock price to plummet. Their limited operating history with current products is also a concern, making it hard to judge their future. Customer retention is key, and if they can't keep customers, or if customers downgrade their subscriptions, their business will suffer. They also admit they may need more capital, and this might not be available on acceptable terms or at all. That's a polite way of saying they're running on fumes, and like many tech companies, they're worried about cybersecurity and data breaches. A hack could be devastating. Privacy laws are also a concern, adding costs and potentially reducing demand for their solutions. Future sales of shares could definitely push the stock price down. They also have a dual-class stock structure, which puts a lot of voting power in the hands of their CEO, Joseph Davey. This means investors have less say in important company decisions. The stock price is all over the place, and you could lose your whole investment. They've also had material weaknesses in their internal controls over financial reporting issues that could lead to inaccurate financial reporting. That's a big governance red flag. All right, let's get into the nitty-gritty financials and see what story the numbers are telling. For the 6 months ended June 30, 2025, revenue was about $6.6 million. That's a huge jump of 209% from the same period in 2024. This massive growth is largely thanks to those recent acquisitions of OpenReel and Vidello, which brought in almost $4.3 million in revenue combined. So the bolt-on acquisitions are definitely showing up on the top line. But with that revenue growth comes increased costs of revenue. For the same period, costs went up by 63% to about $1.2 million. It's not growing as fast as revenue though, which is a good sign for gross profit. And that's reflected in their gross profit, which soared by 21% to over $5.4 million. This is a very healthy expansion at this stage. However, their operating expenses also ballooned by 84% to about $15 million. A big chunk of this is due to those new acquisitions, OpenReel and Vidello, adding their expenses, but also increased salaries, marketing, and professional services like audit and legal work. This is the course of being a public company and integrating new businesses. All this leads to a net loss of about $11.4 million for the 6 months ending June 2025. That's up 38% from the previous year. So while revenue and gross profit are up, the losses are also growing due to expansion and acquisition costs. They also report an adjusted EBITDA loss of about $3.7 million for the same period. This is better than the $3.5 million loss in the prior year, but still a loss. What's interesting here is the reconciliation. You see huge changes in things like gains on extinguishment of liabilities and losses on debt issuance, which really impact that net loss but are smoothed out in adjusted EBITDA. It shows how much of their financial performance is tied to these financing activities rather than just core operations. Looking at the revenue breakdown, the dominance of Demio is starting to shrink. In 2024, Demio made up 91% of revenue, and in 2023, it was 94.9%. Now for the 6 months ending June 2025, Demio is down to 27% of revenue, while OpenReel and Vidello acquired businesses are quickly becoming significant contributors at 42.5% and 22.4% respectively. It's clear their growth strategy is heavily reliant on these acquisitions to diversify their revenue stream. Their net revenue retention, or NRR, is pretty solid at 97.3% for the 3 months ending June 2025. This means their existing customers are mostly staying and even spending a little more. That's a good sign for sustainability. Customer acquisition cost is a bit higher in Q2 2025 at 1,562 2,028. 2025 at when you look at the 6-month period C is actually lower in 2025. At 1,844, this seems counterintuitive as they acquired businesses, but it could mean the acquired businesses have lower initial CRC, or that their overall acquisition efficiency is improving, which is a positive sign. The LTV to CAC ratio is a crucial metric and it's sky high at 9.3 in Q2 2025. This suggests that for every dollar they spend acquiring a customer, they're potentially getting over $9 back in lifetime value. That's a very healthy ratio if sustainable. The 6-month figure also shows a strong improvement from 1.4 to 12.4. This is a very positive indicator of their sales and marketing efficiency. What does Banzai actually do with these products? They have 5 main SaaS products: OpenReel for AI-powered video creation, Vidello for video hosting and marketing, Demio for webinars, the Boost add-on for webinars, and Reach for demand generation. It's good to see them expanding beyond just webinars. OpenReel is their new AI video platform for remote recording, editing, and sharing. Think of it as a way to make professional videos without being in the same room. Vidello is another video tool focused on hosting, marketing, and getting better engagement with features like AWO testing and lead generation forms right in the video. Damio seems to be their core webinar product, offering live and automated sessions with AI moderation to handle audience questions. This AI aspect is interesting as they aim to integrate AI more broadly. Reach is for demand generation, connecting with specific audiences for things like event attendance and newsletter signups. And Curate is an interesting addition, an AI-driven newsletter platform that automatically creates branded newsletters to help brands grow their audience. This really highlights their push into AI and automation for content marketing. Their growth strategy is clear: focus on cost-efficient customer acquisition, keeping customers happy, and expanding their subscriptions, improving existing products, introducing new ones, and importantly, continuing to acquire companies. The acquisitions of OpenReel and Vidello are key to this. Now, about this whole filing process, they're essentially telling us that they're an emerging growth company and a smaller reporting company. This means they get to follow some relaxed disclosure rules, which can make the information a bit less detailed than what you might expect from larger companies. They're also reminding us that they haven't authorized anyone to give information that's different from what's in this prospectus, which is pretty standard legal SIA. Scroll Canary note regarding forward-looking statements. And this prospectus is full of forward-looking statements, words like believe, may, will, estimate, continue, anticipate, intend, expect, etc. They're basically saying these are our hopes and dreams for the future, but they acknowledge that things are unpredictable. They're not guaranteeing these future outcomes, and your investment could be affected by many factors. This is standard legalese, but it's important to remember they can't promise the future. This section is critical for investors. They admit they've had significant operating losses and may never achieve profitability. This is perhaps the most alarming risk. They explicitly state there's substantial doubt about their ability to continue as a going concern, meaning they might not make it for the next 12 months without more funding. They might need to raise more capital, which could dilute existing shareholders, or they might not be able to get it at all. They acknowledge they might not manage growth well, which could hurt their business. They also mention the intense competition from established players like Vimeo, Zoom, HubSpot, and MailChimp. This is a tough market to break into and stay in, and if they can't keep their customers or if they miss out on new product development, their business could be in trouble. Adding to the risk is the potential for future stock sales to drive down the price. All these shares being registered from the SECIA and other financing deals could flood the market. Scrolls have proceeded significantly. They state they will not receive any of the proceeds from the sale of shares by the selling security holder. This means the money from these stock sales isn't going to Banzai to fund operations, but rather to those selling shareholders. Scroll market information for class: a common stock and dividend policent. Their Class A common stock is traded on Nasdaq under the symbol BNZ. They've also had a couple of reverse stock splits, an effort to keep their stock price from falling too low. Importantly, they don't currently plan to pay dividends, meaning investors are betting purely on stock price appreciation. Scroll into the discussion and analysis of financial content and results of Alpischen Cent. This section is management's chance to tell their story about the numbers. They highlight strong revenue growth primarily from acquisitions like OpenReel and Vidello. But again, this growth comes with increased expenses leading to net losses. They show a very strong LTV to CAC ratio, where customers are worth much more than it costs to acquire them, which is a good signal about the underlying business model of their SaaS products. However, this contrasts with the earlier risk factors about serious doubts about their ability to continue as a going concern, suggesting the underlying operational health might be strong, but the overall financial situation is precarious. The OpenReel merger happened in December 2024 for about $19.6 million in stock and warrants. OpenReel is a video creation platform which makes sense as Banzai is building out its video offerings, and the Vidello acquisition in January 2025 cost around $27 million in cash and stock, adding more to their video tech portfolio. These acquisitions are clearly central to their growth strategy. They mentioned having a hearing with Nasdaq about non-compliance with listing rules and then being phased down to the Nasdaq capital market. They did demonstrate compliance later, but the fact they had to do this with reverse stock splits is a concern for stability. They confirmed the 1-for-10 reverse stock split in July 2025 and the earlier 1-for-50 split in September 2024, showing their ongoing struggle with maintaining a healthy stock price. They're an emerging growth company, and a smaller reporting company, which means they're eligible for scaled disclosures. This is why some of the numbers and details might be less extensive than you'd expect from a more established public company. Scroll curtain relationships and tanned party transactions and head. This section often hides interesting insights. They note several transactions with related parties, which essentially means deals with insiders or major shareholders. This includes loans from the CEO and investments from entities connected to their directors. It's crucial to see how these transactions are structured and if they are truly at arm's length. For example, the conversion of old notes into equity involves a loss on debt extinguishment of over $6.5 million with CPBF a related party. This shows complex financial engineering happening behind the scenes. They also have those Yorkville promissory notes, which are convertible into stock and accrue interest at a staggering 18% if there's an event of default. Scroll Principal Security-Holders. Looking at who owns the company, Joseph Davey, their CEO, holds all the Class B common stock, which gives him super voting power. He controls about 36% of the voting power. This means he has significant influence over the company's direction. Major investors like Yorkville are also listed, showing who has a stake in Banzai's future. Scroll Security Holders. This is where we see who gets to sell the shares being registered. Yorkville is the key player here. They're the ones selling up to 25 million shares of Class A common stock that might be issued under that CPR we talked about. So the money from these sales doesn't go to Banzai directly, it goes to Yorkville. Scrolling of distribution sent. How will these shares be sold? Through brokers, dealers, underwriters, or directly to purchasers. It's a pretty standard resale process. They mention Yorkville is an underwriter, meaning they're involved in the distribution. FINRA rules apply to these sales. They're also warning that these sales could happen over a long period and might impact the stock price. Scroll Security Seed. This part gets a bit technical, explaining the different types of stock. Class A gets 1 vote per share, Class B gets 10 votes per share. This dual class structure is designed to keep control with the CEO, Joseph Davey. They also have preferred stock and warrants, public warrants, DM warrants, a whole mix of financial instruments that can all convert into common stock and dilute existing shareholders. The public warrants detail redemption provisions if the stock price hits $9,000 a share, which seems astronomically high given recent performance. Scroll Material United States Federal Income Tax Consequences. This is for you if you're buying these shares. It explains the tax implications of owning Class A stock pre-funded warrants and common warrants. For US holders, dividends are taxed differently than capital gains, and there are complex rules around warrant exercises and sales. For non-US holders, there is withholding tax on dividends, unless a treaty applies. This section is dense but crucial if you're looking to invest. They reiterate their MarTech focus and their growth strategy. The market is huge with thousands of vendors, a fragmented space where acquisitions are key. They mention their TAM, or total addressable market, is expected to reach nearly $40 billion by 2026, and their SAM, or serviceable addressable market, nearly $8.4 billion. These are ambitious numbers. Scroll Products and Services detail their offerings: OpenReel for AI video creation, Vidello for video hosting, Demio for webinars, Boost for webinar advocacy, Reach for demand gen, and Curate for AI-powered newsletters. It's a broad suite, and the AI integration across products is their stated path forward. Scrollman's discussion analysis of financial quadrant and results of Accession Number. This is where management gives their spin on the numbers. They explain that revenue growth is driven by acquisitions like OpenReel and Vidello, while the net losses are increasing due to investments in growth and public company costs. They detail operational metrics like NRR, ACV, CAC, and LTV, showing generally positive trends in customer retention and lifetime value versus acquisition cost. However, the overarching going concern doubt remains a significant overhang when we look at Banzai International Inc. There's a clear story of aggressive growth through acquisition combined with intense financial pressure. On one hand, they're showing impressive revenue growth and strong customer retention metrics like NRR and LTV to CAC, suggesting their core SaaS products are valuable and sticky. The recent acquisitions of OpenReel and Vidello are clearly boosting their revenue significantly, and their strategy of building a suite of MarTech tools with AI integration is a forward-looking approach. However, the alarm bells are deafening. They've consistently posted significant operating losses, and the substantial doubt about their ability to continue as a going concern is a massive red flag. This indicates they are burning through cash rapidly and might need further financing rounds that may not be available or may be highly dilutive. The reverse stock splits are a telltale sign of struggling stock prices. The dual-class stock structure with the CEO holding significant voting power means minority shareholders have limited influence while the acquisitions are... Alright, that's our breakdown of Banzai International's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time. Chip chip.